Warren Buffett doesn't just pick stocks, he builds these incredible value-generating machines. And today, we're going to pop the hood on one of his most important blueprints, the 2012 Berkshire shareholder letter. We're pulling out the exact frameworks he uses, the ones that any serious investor can actually put to work.
Look, beating the market for a year or two, that's one thing. But doing it for nearly half a century, that's a whole different ballgame. In his 2012 letter, Buffett gets past all the platitudes and gives us the actual system that powered Berkshire Hathaway's legendary run.
And the proof is right here in the numbers. Just look at that gap. 19.7% compounded versus 9.4 for the S&P. That isn't luck. That is a system at work. Compounding a 10-point advantage over almost 50 years, that's how you build a legend. All right, so to really get our heads around that system, we're breaking it down into 6 core frameworks. We'll start with how he measures success and how he looks at his own business. Then we'll get into the engine room, his whole concept of float, his rules for allocating capital, and his, believe it or not, super strong case against paying dividends. And we'll wrap it all up with the mindset that makes it all possible.
Okay, first things first. It all starts with the scoreboard. Before you can win, you have to define the game. And for Buffett, the rules are just brutally simple.
This one sentence right here, this is the North Star for every single decision made at Berkshire. It's not about this quarter's earnings. It's not about the stock price today. It's about one thing and one thing only. Does this move increase our intrinsic value faster than the S&P 500? If an investment can't clear that simple hurdle, they just don't do it. Period. And this quote, this shows you the philosophy behind that metric. See, Berkshire is built to win when markets are chaotic, when capital is hard to come by, and everyone else is running for the hills. It's not just a performance goal, it's a strategic decision to be greedy when others are fearful. That's how you create real value instead of just riding a bull market wave. So how in the world do you even begin to analyze a company as massive and complex as Berkshire Hathaway? Well, Buffett's first lesson for any investor is simple. Stop lumping everything together. Real clarity comes from separation. He forces you to look at the company as 4 totally distinct businesses because, well, that's how he sees it. Each one of these sectors has completely different economics, different capital needs, different return profiles. When you analyze them separately, you get a much, much clearer picture of the whole operation. It's a really powerful tool for looking at any complex company. Okay, now we're getting to the concept that is absolutely crucial for understanding the Berkshire machine. This is the secret engine that has been propelling its growth for decades. I'm talking about the magic of insurance float. Most people look at the cash an insurance company is holding and they just see a liability. It's money they owe to other people. But Buffett's genius was to see it totally differently. He saw it as this massive revolving fund that he gets to invest for Berkshire's benefit. It's capital, but it's a very special kind of capital. And the scale of this engine is just staggering. Look at this growth. From under $40 million in 1970 to over $73 billion by 2012. That is a gigantic, almost cost-free pile of cash that fuels all of Berkshire's other investments and acquisitions. And here's the real kicker. Because Berkshire's insurance businesses are run so well, they consistently make an underwriting profit. So what does that mean? It means the float isn't just free money. They are literally getting paid to hold it. For any investor looking at an insurer, that's the billion-dollar question. Is their float better than free? For Berkshire, for 10 years straight, the answer was a loud and clear yes. All right, so you've got all this capital pouring in from the float. What does Berkshire actually do with it? Well, Buffett lays out a super clear 5-step framework for how he thinks about putting that money to work to grow the business's intrinsic value. And here it is. This is basically a checklist you can use to analyze almost any company's capital decisions. Number 1, reinvest in what you already own. 2, make small, smart acquisitions that fit. 3, let your existing investments grow. 4, if your own stock is on sale, buy it back. And only then, as a last resort, do you look for that giant whale of an acquisition. It's disciplined, it's easy to remember, and man, is it effective. This brings us to a part of the Berkshire philosophy that's a bit more advanced and often goes against what everyone else says. Most companies get praised for paying dividends. Buffett makes the case that, for a company like his, it's often the absolute worst way to return capital to shareholders. And to prove his point, he sets up this little hypothetical. Imagine you're a co-owner of a business. With choice A, the company just pays you a dividend. Simple. With choice B, the company keeps all its earnings to reinvest, and you just sell a tiny piece of your stake each year to get the same amount of cash. He wants us to do the math. So let's look at the traditional dividend route first. The company grows with the earnings it keeps and pays you the rest. After 10 years, your stake is worth just under $2.7 million. That's a great outcome, right? But let's see what happens when we do it Buffett's way. By keeping all of those earnings, the business gets to compound at a much faster rate. And by letting you, the shareholder, create your own dividend by selling off tiny pieces, your final value is over $2.8 million. That's a full 4% higher. It's not a matter of opinion. It is mathematically just a better result. So why does the sell-off idea win? It really comes down to three things. First, it's all about shareholder choice. You decide exactly how much cash you want and when. Second, it's way more tax efficient. And third, you avoid that ridiculous situation of getting a dividend check just to turn around and buy more of the same stock on the market, often at a higher price. In the end, it's about what creates the most wealth for the actual owner. So all of these techniques, these frameworks, they're all held together by one final, really powerful message from Buffett. It's the core philosophy that lets an investor sleep at night and weather any storm. This quote is the perfect antidote to that constant drumbeat of short-term uncertainty you hear on the news. I mean, while other CEOs were panicking, Berkshire was out there spending a record $9.8 billion on new plants and equipment. This quote is such a powerful reminder that the fundamental game of investing in productive businesses is massively stacked in your favor if you just stay in the game. And that right there is the final takeaway from this whole letter. It's a direct challenge to every single one of us. The real edge isn't in trying to read the market's tea leaves or reacting to every single headline. It's in having the discipline to ignore all that noise and focus on the one thing that has consistently created wealth for centuries: the ever-increasing value of great businesses over time.